Hello viewers, I'm Sanjeev Pandya welcoming you to another episode of the Tax Time. Your taxes matter, as you know by now. Of course, this is the tax season currently going on, and we bring you all the latest updates on the tax laws, reforms, changes in the tax laws for your knowledge in this show, of course, with the help of Mr. Ajay Kumar, CPA of Sai CPA Services. Sir, welcome to the show.
Thank you, Sanjeev.
Once again, good to have you here.
My pleasure.
Taxes are based on income.
Absolutely.
Income,
That's
and you
why
pay
they're
taxes.
Income tax.
Income tax, that's right, based upon income. But now, let's just talk about foreign income. What exactly is the foreign income, and do you have to pay tax on foreign income? To start with the simple question.
Well, it depends what kind of income you have, as you rightly said. So, at a high level, there are two types of income, earned income and unearned income. Earned income meaning you worked for it. So, you have a job, a deputation, an assignment in a foreign country, and you're working in a foreign country, that's earned income for you. Then there is unearned income. For example, interest income, dividend, rental income. You are not actively working for that income. So if you have unearned income, you got some interest, some dividend, some rental income, you must include that income when you file your US tax return. So that income is taxable to you.
Gotcha.
But the caveat is, if you paid taxes to a foreign country, that tax may be deductible against your tax liability. Let's take a simple example. If your US income is $100 and you had $10 of unearned income, interest income, dividend or rental income, let's say in India, and you paid $1 to the Indian government. You include that $10 in your US income, so now your US income is $110. And let's say the additional tax liability turns out to be $2. You say, hold on, I already paid $1.
So you get a credit for $1 in a US tax return.
Absolutely.
Okay, so that's good to know. So that means that's what we're going to be discussing a lot on foreign income, because foreign income is something I think our viewers want to know a lot more on this issue, because you know, lately all this young generation who have migrated to US, of course, they have left money in the bank account over there. They have properties over there, certain assets over there, and there's always a confusion on what to report, what not to report. So let's just give them as much detail possible in this episode. Question number one would be, who must file and what is F-bar? Because with foreign income I hear F-bar. So let's start with who must file and F-bar.
So F-bar stands for Foreign Bank Account Reporting. F-bar or FinCEN, the new name for the F-bar is FINCEN, FinCEN 114. F-bar or FinCEN reporting is needed if you have foreign asset. F-bar is not related to foreign income. If you have foreign income, you must include it in your US tax return. You may have certain exclusion that we'll talk about, but F-bar is all about foreign assets. You have to see if this asset that you have in a foreign country, if it's a liquid asset or a non-liquid asset. Now, if you have a liquid asset, the limits are very different than if you have a non-liquid asset. If somebody has a liquid asset, cash, CD, mutual fund, something that you can easily convert into cash, money, that's liquid asset, then the filing requirement is $10,000. All accounts combined together, if somebody had more than $10,000 at any given point of time during the year, they must file F-bar. Let's take an example here. If you're trying to buy a home, you transfer, let's say $10,000 over there. Just for one day, $10,000 were in your account, then you gave this money to your friend, family, or to the builder. But for one day, you had more than $10,000 in that account, in your account.
Nice.
So you have to file the F-bar.
So it becomes a taxable income, taxable transaction rather.
It's not taxable transaction. It's a filing requirement. F-bar is all about filing. There is no
just for reporting purpose.
Just for reporting.
Just for reporting purpose, you must mention it.
Absolutely. There is no tax liability for F-bar or FinCEN. People, if you have $10,000 worth of asset, if you have $100,000 worth of asset, it does not change your tax liability when you file the F-bar. Unless you have the income, you don't have the taxes.
Okay. With that note, question comes to my mind is how much of foreign income is tax-free in the US?
Well, it depends. Again, if you have the earned income, then there are certain exclusion, as opposed to if you have unearned income. If you have unearned income, then you must include that income. You may be able to get the tax credit that you paid to the foreign government, but you have earned income, you need to include that earned income in your US taxes. But let's say if somebody is working on a deputation, somebody got this assignment over there and they are working, let's say in India, and they are living there, they are earning money over there, and they are paying taxes over there. In that case, IRS has two exclusions, either the bona fide resident exclusion or the physical presence test. We have listed these two tests for our viewers. So if somebody lived for more than 330 days in a foreign country, they can exclude up to $105,900, and these limits changes every year with CPI, with Consumer Price Index. So either if you have the bona fide resident test, what it means is you have set up your resident in a foreign country, and the way the IRS looks at it, if you have bought a home, if you have driving license, if you have taken the citizenship of that country, all those tests are used to decide if you are a bona fide resident of that country. In that case, you can exclude $105,900 of your earned income. So you don't get the tax credit. You can either get the tax credit or you can exclude the income. You still have to include it. So the way, let's take an example just to clarify for our viewers, Sanjeev ji. Say if somebody's income is $100 in US because they lived here for part of the year.
Correct.
They moved to, let's say, in India. That's where they earned income and they have set up their bona fide resident over there for all material purpose. They earned $100 over there. So the way they will have to file their US taxes, they show total US income $100, total foreign income another $100, total income $200. Income that can be excluded is the income coming from India, minus $100. Taxable income $100.
I see.
So they still have to report everything.
Okay, so now with this reporting, FBAR reporting, and then taxes and a certain foreign income that you have to pay. Question that I have for you is that what's the difference between, let's say, US citizen, somebody who is a US citizen, and what do they have to follow the same rules versus someone who's on a green card or H-1 visa whose citizenship is not confirmed yet? Do they still have to pay the same kind of taxes and follow the same things?
Well, the way the IRS looks at it, either you are a resident or you are not a resident. The residents are defined, all the green card holders are resident, all the US citizens are resident. H1 people who have lived in this country for more than 183 days are...
So more than 6 months, yeah, obviously.
More than 6 months, exactly 6 months. Then they are considered as resident. We don't really look at the visa status. We don't really look at the legal status.
No, it's just for curiosity that I wanted to know, because if they are, let's say, not so legal in this country, do they still have to pay the same tax liability as a citizen and green card holder?
Well, if they are not legal in those terms, meaning they don't have the social security number and they don't have the ITIN, a lot of times people with the foreign income, if they have investments in US, they have the right to get ITIN. It's called Individual Tax Identification Number, ITIN. So if they have the ITIN, they still need to file the proper taxes. But if you don't have the SSN, if you don't have the ITIN, then you're not legally here.
Okay, sir. But most likely you will definitely have SSN, and most likely that you'll be working here. So anything more than 6 months, you consider as a resident here for the tax purposes.
For the tax purposes.
Okay. With that note, we're going to take a break. But viewers, more on foreign income, a very useful, important information coming your way after this messages. Please stay with us. Welcome back to the second segment of the Tax Time. Your taxes matter. Today we're discussing on foreign income, taxes on foreign income, what to report, what not to report, what are your liabilities. Of course, Ajay Kumar, CPA, Sai CPA Services is with us to give as much information possible.
Absolutely, Sanjay.
If someone, after migrating to US and becoming a resident here, if someone inherits a home in India, which happens in many cases that I've seen, they immediately get confused now what to do with it, because if they decide to sell home and whatever income that they generate, what are their tax liabilities here in the US?
Absolutely. Great question, Sanjeev ji. Very, very interesting. There are two aspects to the situation. inherited the home, meaning now they own a non-liquid asset over there. There are different filing requirement, FBAR filing requirement, no taxes. Just by inheriting the home, you did not trigger a tax liability yet. When you sell the home, you got some money over there.
But in between there, you must report it here in US tax. Report in a sense, just let them know that you have inherited a home in India.
Absolutely. So,
Okay.
and let's understand why is it done this way.
Exactly.
And let's take an example. Let's say last year somebody inherited a home worth $200,000. In that year, for that year, they will do a filing, FBAR filing, and we have listed the limits for our viewers over here. If somebody has more than $100,000 at the end of the year in non-liquid asset, so if the home is worth more than $100,000, then they have to do the filing. Or if the value of the assets were more than $150,000 at any time during the year, they have this filing obligation. And these limits are only for non-liquid assets. Home is your non-liquid asset. This is just for the filing. And you wonder out loud, what's the point? Why do I have to do the filing for my non-liquid asset? Now take it forward. Next year you end up selling the home. And then you say, I sold the home for $200,000. My home, when I inherited, was $150,000. You only pay tax on $50,000. You don't pay the tax. But if you have not done the filing, how would the IRS, how would the government know how much was the value when the house was inherited?
Okay. So now let's just talk about it. That, I mean, you explained that once you report it and once you sell it, what you need to do. There are some people who are kind of, let's say, either skeptical,
right,
or reluctant in this matter. They are like, okay, I have inherited home in India, and I'm not going to report it. How is IRS going to know? One is one thing, and there are people who are not aware of this situation at all. So one is group of individuals, they say, I'm not going to report it because they think maybe their tax liability is too much. They get scared and they don't want to report it. It's in India, when I sell it, we'll see what happens. And there are other group of individuals who are not aware of these things. In the both groups, one common thing is they missed filing on FBAR.
Right.
What could happen?
Well, if somebody missed the FBAR filing,
what are the penalties rather?
Penalties are huge. If somebody had unintentional miss, I just came to this country, I did not know any better, this is my first year. This is unintentional missing of the filing. The penalties in unintentional case is up to $10,000.
Unintentional case, $10,000?
If somebody missed it intentionally, if you knew about it, or if you have been here for multiple years, you should have known about it, the penalties could be up to $100,000 or 50% of your asset value, whichever is higher. So the penalties are huge. What we recommend to all viewers, if they have missed the filings, if they have not done the filing, please take time this season and go back 3 years. You still have the right to do the filings for 2017, 2016. When you do the filing for 2018, do the filings for last 3 years.
Okay. That's a very interesting point. I mean, penalty is really, really steep, and that's why you need a very experienced and knowledgeable CPA for that. All right, what are the tax tips that you can share with us when it comes to foreign income for our viewers?
So when it comes to foreign income, you need to understand the timelines first. You need to understand your responsibility so you can minimize it. The last thing you want to do is not do the proper filing. So FBAR filing, the foreign income needs to be included with your tax return. So foreign income needs to be reported along with your taxes. So the deadline is when you file your taxes. And so is the FBAR deadline. FBAR deadline is when you file your income tax, meaning the deadline becomes April 15th. Now you have to take a step back. What kind of income do I have? Is it earned income? Is it unearned income? If it's earned income, can I qualify for one of the two foreign income exclusion tests, bona fide resident test or physical presence test? And we have shown the slide for our viewers. If it's unearned income, can I claim the tax credit? I paid certain taxes to the foreign country. Do I have the right to claim those credits over here? Then this is the income side of it. Then you look at the asset side of it. What kind of assets do I have in India? Are they liquid asset? Are they non-liquid asset? If they are liquid asset, then the guidelines are very different. More than $10,000 at any given point of time, combining all accounts. Then you have to do the filing. The good thing here is a lot of people get scared. They don't want to do the filing because they think they have to pay a lot of taxes. What we want our viewers to know, FBAR has absolutely no tax obligation. The filing is mandatory. There is no tax liability with the FBAR filing. You just have to know, is it a liquid asset or it's a non-liquid asset. If it's a non-liquid asset, this $10,000 limit changes to $100,000 at the end of the year or $150,000 during any time of the year.
Okay, that's a quite a important information here it is. Now, before we go into the break, the question that I have that is that when a home is inherited or any kind of asset is over there, obviously you have to file taxes and everything in that country, whether it's India or any other country that we're talking about, right?
It depends.
Okay, and then when you do that, whatever the transaction is, let's say for example you paid 1 lakh rupees tax
Right.
in your country, right? And you claim a credit over here in the US on a US tax return. Does that become very often kind of red flag item, or IRS kind of lets it go so long as you reported it, it's okay and it's fine with it, or do they really go into the deep to figure out if it's right or wrong or whatnot?
Well, that's a great question. The way this country is set up, everybody is immigrant. Everybody came here
Yes.
from a different country, so it's very, very common to have foreign income. So foreign income
Ji.
credit, foreign income exclusion is not that uncommon.
Okay.
We see this on a very, very
So it is
regular
accepted
basis.
by IRS.
It's quite acceptable.
Quite, I would say, comfortably. I mean,
Yes.
they really don't go into too much of detail.
Well, you have to have the proof. You have to submit.
Oh,
the,
absolutely, yeah,
Yes.
with all the proof and everything. So it's better to make it simple. Whatever it is, whatever that you own, whatever bank accounts you have, whatever money that you have parked in the bank accounts in your country, might as well just report it and keep it simple.
You keep it clean, so you don't have to think about it. Otherwise,
Okay.
you keep thinking about it. What if somebody finds out? What are they going to do with it? What are the penalties? If you just report it now. You don't have to worry about the penalties.
Don't avoid it. That's the bottom line. With that note, we're going to take a break, but we're not done with foreign income because a lot more coming your way after this messages as well. Please stay with us. Welcome back to the third segment of the Tax Time. Your taxes matter. Every week in this show that we talk about, actually we touch upon any tax issue, tax matter, which is most relevant to you viewers. And if you have any question, if you want to know any information on taxes, you can send us an email, taxtime@tvasiausa.com. That's our email ID. Do send in a question and Mr. Ajay Kumar, CPA, Sai CPA Services, will be more than happy to answer your question. Will you answer my question?
Absolutely, Sanjeev.
Okay, you've been doing it anyway.
Absolutely.
All right, question is that as we're talking about foreign income and everything, mainly we touched upon people who are living in US after migrating to US and having some kind of assets, liquid assets, real estate, whatever in India. Now let's go reverse.
Right.
If someone moves out of US for good to their own country, in this case, let's say India, what are the things that they should be very careful and what they must do after moving to India?
Very interesting question, Sanjeev ji.
Thank you.
It's happening more now than it ever did. A lot of people who worked over here for several years are moving back to India, and a lot of US citizens, green card holders,
Yes.
are moving back to India for
Correct.
good, living there.
Absolutely.
And the filing requirements are different if you are not living in US, if you are living in India. So you have to see if you have somebody living in India and they are working over there, they have earned income, they have unearned income over there because they are working somewhere, they have bank accounts, they have assets over there, they have bought home. So their limits are different if people are living outside US.
Okay.
So first thing first, if they are living outside, they qualify for bona fide resident tax. So they don't have to pay any tax on first $105,900 of their earned income. They are still required to file their US taxes. If you have income, the US tax return must be filed on global income, Sanjeev ji.
Oh, okay.
So if somebody had $100,000, let's take an example, income in India, earned income. They file their taxes in India, then they file their US taxes, and they say total global income 100,000, income excluded 100,000 because the limit is $105,900 for the earned income. Total taxable income 0. So it becomes only the filing requirement as opposed to the taxable situation.
Correct.
But if somebody made $200,000 in India, So first 105,900 is excluded. For the remaining income, they still have to pay tax in US.
I see.
If you paid any taxes in India, you have the right to claim the credit, the tax credit for that income tax that you paid to a foreign country against your US tax liability. But that's just the income tax situation. If you moved to India, probably you bought a home, you created a bona fide resident. The second part of the filing requirement that we have been talking about in this show is the FBAR FinCEN filing. Do they have to do the FBAR filing? For them, the filing requirement is very different. If they have more than $400,000 worth of non-liquid assets, as opposed to 100,000 for the US people who are living in US, the limit is 100,000 at the end of the year. For people who are not living in US, they have set up their bona fide resident in a foreign country. For them, the limit becomes 400,000 at the end of the year, or 600,000 during any point of time in the year. So the limits changes. Limits are 4 times greater.
Correct.
If somebody is living outside the country.
Okay, but so long as you are a citizen of USA, right? Obviously, you're obligated to file tax returns and everything. Once you decide to give up US citizenship, then you don't have to worry about all these tax liabilities here in US.
That is true.
Okay.
So the US law says if you are married filing jointly, then up to 24,000 standard deduction, you don't have to file any income tax. If you are making more than $24,000 in any country, or if you have more than $400 of unearned income globally, you are required to file a US tax.
Okay, very nice. Now let's just talk about gift. With IRS and taxes and income, gift is something unusual word, but let's just talk about gift. People, a family living here in US, and they receive a gift from their parents in India. They say, okay, we're going to write you a check, or we're going to send you, for example, $100,000.
It happens.
It's a gift, legitimate gift from parents or family member in India to here in the US. What are the tax liabilities, implications, anything?
Well, the gift is typically not taxable.
Gift is a gift.
Gift is a gift.
Gift is a
it's
gift.
not
Okay.
tax deductible for the person who is giving the gift, and is not taxable for the person who is getting the gift.
But you must report it. You must.
Well, the US limit for non-reporting
Yeah.
is $15,000. If you got a gift from US person to US person, up to $15,000, there is no reporting requirement. You don't even have to report it. For a foreign gift that we are talking about,
Right.
if somebody got the gift from a foreign parent, parents do not have the social security number, parents do not have the citizenship, in that case, the gift limit is $100,000. If you are trying to buy a home, and your parents from India are giving a gift of $100,000 to you, you don't have to pay any taxes on that money. You don't even have to report that $100,000 on your US tax return.
All right. How many normally cases that you get, or how many clients that you have normally that one is that they are not aware of this FBAR rules and regulations and everything, and yet they own properties or have liquid assets in India, and you really guide them?
We do hundreds of FBAR filing every year.
Okay.
I used to come across not new about the FBAR cases, a lot of cases in my earlier years, but now it's became so common, and there is so much propaganda, so much communication about it, that a lot of people now know about FBAR. I don't really see that many FBAR cases that we did not know about it. Can we file for last 3 years, 5 years? As much as I used to see in my past years.
So for filing FBAR and everything, obviously, as we say, that you need to consult an experienced and knowledgeable CPA here. That's a one thing. CPAs, or CAs rather, I'm sorry, CAs in India, chartered accountants, are they aware of this situation also for US? Would they guide their client who is actually living in US properly about their assets and taxes and everything?
That's an interesting take. So when somebody asks us that they have some Indian income and they are required to file Indian taxes, can you help us? We politely tell them, for Indian taxes, the rules are different. We don't practice the Indian tax laws every day. They are better served by using a CA in India to do their Indian taxes.
But are they knowledgeable? Are they aware of US tax rules and liabilities and everything?
Not everyone would know.
Oh, okay.
So the right thing would be, if a CA is getting this type of call for a US tax, they politely refer that case to a CPA in US.
Okay.
You don't want
so
to be
it's a good idea to connect both of them together.
Absolutely.
Okay, that is the point I wanted to make. Okay, anything in the end?
The last thing our viewers want to do is not report. You don't really know what you don't know. And there are a lot of ways for IRS to find out. Even if you just inherited the home, you sold it, eventually we'll have the money trail. You will bring the money sometime over here, you will spend the money over there. It's trackable. Even if you were to deposit the money in an Indian bank,
they're going to ask you a question too, obviously.
Will report it to the US
There's
Treasury.
so much transparency nowadays. So it's better to report it, do all the proper filing, and for that consult a very knowledgeable, experienced CPA who can guide you in that matter. Ajay Kumar, sir, thank you so very much
You're
for
very welcome,
all the
Ajay.
information on this foreign income. I think this was a very, very hot topic that we wanted to let our viewers know as much information possible. Viewers, I hope that you found it interesting. Remember, any question you have, text time at tvasiausa.com. I am Sanjeev Pandya, wishing you all happy and tax-free foreign income reporting if you have to. Otherwise, have a good week ahead. We'll see you next week, same place, same time. So long.